Welcome everyone to our Q1 2023 market update. Here with me is Joshua Joffe, our Managing Director and Head of Investments. How are you doing today?
Doing well. Good morning, Daniel. Very formal.
We're still in sweaters.
Yep.
It's April. We had a nice couple weeks of good weather, but we're excited for the summer. With that said, you know, we were here 2022. Look back. Now we're 3 months ahead. Lots changed. What we'd love to do is walk our listeners through what's happened in the first 3 months of the year, what we're seeing going forward. And with that said, a couple updates from previous presentations. One is if you'd like to toggle Josh and I to be bigger or smaller based on your preference, feel free to do it right through the webinar. But we're going to show the presentation and we'll be here. Second thing is we're going to be sending out the slides for everyone at the end of the presentation. So don't worry about missing certain things. We're happy to also get on the phone and walk anyone through any details, whether Josh, myself, or anyone else on the Revolve team. So with that said, let's do a quick look back on 2023 first quarter. So Josh, as we look at this, anything stand out to you?
So yeah, I mean, what jumps out to me is the resiliency, right? So when we look at market returns for the quarter, year to date, the S&P 500 was up 7.5%, right? This is now back-to-back quarters of gains. Global equities up about 8%. Volatility was actually pretty mild up until till March, when we got some banking concerns that we'll talk about in a few. But you know, really, it was just another terrific quarter in terms of market performance. You know, we can drill down, Dan, into some of the themes and highlights that we noticed.
Yeah, so that's the broad indices. So as we go through, let's talk about what worked, what didn't work, sort of on a high level.
Yeah, and you know, I think if 2022 was the year where pretty much nothing worked, you know, fortunately, right, 2023, at least year to date, a lot of things have been working. And I think what's interesting is a lot of things that did not work last year are working particularly well, and the few things that did work well last year, not so much year to date. So for instance, we look at growth versus value, right? Last year, value stocks outperformed growth by almost 20%. This year, they're lagging by 12. If you recall the mega cap growth names, a lot of the less profitable tech companies,
yep,
they really struggled last year. This year, they're leading. Nvidia is up 94% year to date. Amazon's up 20, Apple's up 32. The generals are back, so really been encouraging. Energy and financials, which worked really well last year, they're actually the laggards. The NASDAQ, believe it or not, is in a bull market. NASDAQ is up 25% off of the lows from October, best quarter in years. And the NASDAQ is now outperforming the Dow, and that's what we're seeing here on the left, outperforming the Dow by the widest margin since 2001. So a lot of encouraging signs, large caps outperforming small caps. And, you know, maybe for the first time in a long time, if you look on the right, we're starting to see international equities perhaps meaningfully outperform US equities. And that trend line is showing just how long it's been since that's actually occurred, right? We're going on now 13 years of US outperformance. And in the very right-hand corner, you're starting to see perhaps that trend reverse as well.
Exactly, Josh. And again, those reversals are exactly why diversification matters.
Yeah.
Growth to value, sector to sector, international to domestic. So clearly, there was a major headline in the first quarter of this year, specifically Silicon Valley Bank. So if we could, Josh, let's walk through that, what you saw on your side, how it's meaningful to our investors, and then we're going to also talk what else it caused throughout, you know, the entire banking and financial industry.
Yeah, you said Silicon Valley Bank. I must have missed that one. No, that was of course the big story, or one of the big headlines. And I joke because it was just a few weeks ago, and it seems like a lot of the worst fears, fortunately, knock on wood, were not realized. But I think to understand what actually happened, we kind of have to take a step back and look at the business of banks. Fundamentally, right, banks are an intermediary between savers and borrowers. They take in deposits, they lend out, right? They borrow short, they lend long. And one point that I think is really, really critical to understanding what all of this means is that deposits, right, when we add deposits to the bank, those are liabilities of the bank, right? We're depositing money at the bank, and the bank is then effectively loaning that money out to somebody else. They're using our deposits to make further loans. So those deposits are liabilities. And the difference between the loan rates and the deposit rates, that's the bank's profit, their margin. Now, it takes time for banks to convert those deposits into new loans. And when the world is awash in liquidity and cash, as it has been for several years now, the bank is not going to be able to issue as many loans as deposits that they take in. So they typically will put some of those deposits into safe investments like government bonds so that they can earn some more interest in the interim. And what happened was during the pandemic, banks took in record volumes of new deposits, right? From the end of 2019 through the beginning of 2022, deposits at US banks rose by $5.4 trillion, right? And only 15% of that volume, there was actually demand for new issuance. So the rest was all invested in and sitting on bank balance sheets.
Super safe US treasuries, supposedly laddered out.
Exactly. Safe treasuries, government bonds, right? Now, banks that hold bonds on their balance sheets, as all of them do, the value of those bonds is going to fluctuate with interest rates. And if we understand a little bit of bond math, right, as rates rise, bond prices fall, right? If held to maturity, right, these safe government bonds will return the par value. But if they need to be redeemed or sold early, right, there is that price fluctuation. So that represents an unrealized loss for the bank.
Yep.
In the event that there are redemptions. Deposits are stable, it's not an issue, but the minute the cash needs to be redeemed prior to maturity, right, it creates that loss. And our friend Ben Carlson, I thought, had a great analogy, right? Planet Fitness, right? If everyone with a Planet Fitness membership, which is basically everyone I know, except for me, it's $9.90. I don't know how they do it for $10 a month, but if everyone with a Planet Fitness membership decided to show up at the gym at the exact same moment, right, it would be chaos. They would not have enough racks, enough equipment. Now that doesn't happen, but in theory it could. And that's precisely what happened here. We had an old-fashioned bank run when the depositor base at Silicon Valley Bank all at once decided that their money wasn't safe and they had to pull it out, and that created all of these losses within a span of 30 hours, right? The 16th largest bank went under, 8,500 employees, second largest bank failure in the history of the US. So really, really remarkable, just kind of how it all unfolded.
And really just predicated on mistiming of when their funds become available to when their depositors are looking for cash back.
Yeah.
Right? To me, that says risk. To me, that says mismanagement of risk. Right? And we'll talk more about how that sort of relates to the private wealth side and what clients are doing when they need cash. But it could have been avoided.
Mm-hmm.
It probably could have been avoided. Right? And I can't imagine that SVB got all excited about 2% 30-year treasuries, right? Yeah. A year and a half, 2 years ago when they were collecting these deposits and going out long. But that's the market we're in. Tell me about, plenty of people were commenting. I think we saw a great quote from JP Morgan specifically about SVB. Do you want to opine on that a little bit?
Yeah. So, and that's actually what these charts are showing. People say it's a perfect storm. Well, JP Morgan, they said that SVB was really in a league of its own, right? So here you've got a high level of loans plus securities as a percentage of deposits. So if you look at that chart in the top left, SVB is all the way on the lower right quadrant, right? They carved out a riskier niche, right, in the sense that on the bottom, their depositor base was very much, right, Silicon Valley Bank, right? Their depositor base was almost entirely comprised of venture capital investors and tech firms, biotech firms, all in the same region. And, you know, crazy enough, only 6% of them held $250,000 or less, right? That's the FDIC limit for insurance. So you had a lot of very large accounts with uninsured deposits belonging to depositors who were all in the same industry, all in the same region, right? And it's as easy as that. All it took was a couple of prominent VC firm founders to issue a warning, and everyone at once, you know, ran to pull their money. And you're right, it was avoidable, because had they not done that, right, this herd mentality, the bank would not have failed. And there's plenty of blame to go around, of course, right? SVB did not do a good job of managing, or rather matching, right, their assets and liabilities and the duration between them. But it really was a very unique situation, and almost a perfect storm in how it played out.
Thanks, Josh. Appreciate that color. So let's zoom out a little bit, right? So we've had this issue on the West Coast. Has that changed investor behavior? Has that changed anything that's going on in the marketplace? Let's talk a little bit about money markets.
Yeah, and that's a great segue. And you know, it has changed a number of things, and I think to some extent, you know, we haven't yet seen the impact, right? There could be a tightening of credit, there could be a ripple down effect, there could be other regional banks that are facing pressure, and small businesses in turn that will show up in the data over time. But I think there are a number of lessons that are really applicable for our listeners. One of them is just another reminder to me. It's kind of mind-boggling, but the perils of market timing and concentrated bets. So, you know, what happened after March 8th, I believe it was, right? The Fed stepped in, and the Fed effectively came out and said they would backstop all depositors, and they created a credit facility, and they, for better or worse, I mean, for better, but depending on your opinions on moral hazard or whatnot, the Fed effectively instilled enough confidence that this did not turn into the financial crisis 2.0 that people feared. But what's really interesting to me in terms of what the market did, you know, yeah, in the immediate aftermath, right, the regional banks, which are a tiny subset of the stock market, were down 13%, right? More broadly, financials, which are a smaller subset, were down 12%. The S&P 500 barely moved, and then it went up, and it finished up 2.3% from that point. The bond market went up 3% from that point. So, with the benefit of hindsight, right, everyone, you can theorize, well, what happened? Okay, people realize that this is the signal, this is the bell that's ringing that's going to get the Fed to maybe recognize that their policy is setting us on a bad path. They're going to shift and become more accommodative. That's a good thing for the markets, right? We can come up with these explanations and rationalizations after the fact. But what really fascinates me is if you had told me in advance, if I had tomorrow's news today, which I don't, if you told me Silicon Valley Bank was going to fail, and Silvergate was going to fail, and Signature was going to fail, and First Republic Bank was going to be on the verge, and the Fed would come out and raise rates again a week later, and the FDIC and Treasury are going to put these emergency measures into place, right, to keep investors calm. If I knew all of that in advance, I would have told you markets down double digits. Easy, right? That did not happen. And to me, that's one of the key takeaways, right? And that's why it's so hard to successfully predict what markets are going to do or time. That's why taking concentrated bets, right? Because the prudent thing to do, the rational thing to do is say, oh, these banks are about to fail. Let me pull my money out of the market. Let me get short. Let me reallocate. And that was the absolute wrong thing to do.
Sure.
We've seen it over and over and over. And I think it goes back to the nature of markets being complex adaptive systems. We've talked about this at length, but you know, one small change could trigger things that we can't possibly imagine. And I think that's a really important lesson for all of us. One other thing that I thought was really interesting, Morgan Randstrom, he called it unrecency bias. right? We hear bank failures and we immediately think, oh, credit, lending, leverage. That's not what happened here, right? We're talking about government bonds and treasuries.
Right.
What
The
happened?
safest of assets.
The safest of safe assets, right? It wasn't a matter of credit, right? They weren't reckless in their lending, right? They simply did a terrible job of managing the duration, the interest rate risk. And it's not the first time that's happened, but it's the first time in a long time that that's happened. And that's why, you know, the unrecency bias, we're so focused on credit, and now we're going to be so focused on duration.
Yeah.
And it's going to be something else that gets us.
For sure.
And that, you know, Dan Kahneman, who's the father of behavioral finance, you know, he says that the lesson that we should take from unpredictable events, we all like to draw these causal relationships and say, oh, now I learn, now I understand why, and it's not going to happen again. I figured it out, because that's the wrong lesson, right? The lesson to learn is that unpredictable things happen. Life is unpredictable.
You'll be surprised again.
You'll be surprised again. So prepare to be surprised, right? Don't prepare for the next, you know, banking crisis that's spurred by duration. Be prepared for unpredictable events that nobody can think about.
Right. And through this, right, as we see on this chart, we clearly see additional cash coming out of regular bank deposits, now moving into money markets, right? It's something we've been doing for a year now, since you were getting more than zero in a money market or the US Treasury securities, get some yield. You know, this is the first time since, you know, probably early 2000s with orange savings accounts where you're getting 3, 4, 5% on your cash. So I think that's stimulative in some instances. We can talk about that offline, but
yeah,
really interesting how we've sort of seen cash coming from bank accounts into purchase money markets as rates have gone up, and as also the other component is we custody with Charles Schwab. That's our main custodian. And Josh, could you talk a little bit about the difference between the banking deposits and brokerage deposits, purchase money markets versus cash sweep accounts, if you could?
Yeah, for sure. And Dan, you alluded to it, right? Banks are losing deposits, and that's what these charts are showing. And you know, it's always mind-boggling to us, right? It's like the risk-free rate or short-term treasuries could be at 4.5%, 5%, money markets yielding 4.5%, and you know, I won't pick on any specific banks, but your local bank is paying you 0.2% in your savings account or your checking account. So, you know, banks are losing deposits because yield seekers are leaving. We're seeing the flows out. And the problem is, right, banks, right, if they don't cut, right, or if they don't raise those rates, they're going to continue to bleed deposits. If they do raise those rates that they're paying on deposits, it's going to cut into their margins, right? And the other option, of course, well, if the Fed lowers the Fed funds rate, which in turn informs, right, all other interest rates, well, then they risk higher inflation, which is precisely what they've been raising rates this whole time to combat. So it's a tough situation, right? We're seeing play out in the banking sector, but it's an opportunity. And we've got many clients who are shifting money that they have in the bank that's earning effectively zero, shifting money to money markets, to treasuries, and picking up meaningful yield without taking on risk. And if that applies to anyone listening, give us a call. We can help facilitate, of course. But you know, to get to some of those distinctions between, you know, the brokerage side, the Schwab side, and the banking side, right? It's really not comparable. You know, Schwab, a brokerage account, it's not governed by FDIC. It's governed by SIPC in terms of the protections, which are $500,000. But more importantly, you purchase a purchased money market fund. That's an asset that you own.
Or a stock or a bond, any other security.
Right. Any other security, exactly. That's a physical, tangible asset that you own. Whereas a deposit, as we went over earlier, a bank deposit is effectively a loan to the bank that they then loan out in turn. So there's a world of difference. Schwab, on top of that, has, I think it's 150 billion in added depositor insurance through Lloyd's of London. JP Morgan also went over just where Schwab stands. And in fact, if Schwab were on that chart that we had up a moment ago, just based on their loan to deposit ratio, they would actually be at the opposite extreme. They would have the lowest, the safest ratio. They got $7.5 trillion in client assets. Of the 21 US banks, 11 European banks that they monitor, Schwab's 1.39% return on asset would be the third highest. So in our view, there really is no comparison. We're talking apples and oranges, but there are, as we said, opportunities for clients to potentially shift some funds if it makes sense to do that.
Absolutely. So we touched on Fed funds a little bit. Let's switch gears, more macro type environment. Let's talk about what the Fed's doing. Let's talk about, last 12 months, right? Talk about if you knew what was coming, right? 12 months ago, maybe 18 months ago, and we talked about this in our Q4 update. No one predicted rate hikes. We've now just seen 12 months of rate hikes from 0 all the way to 4.5%. If you could just remind people, I know you touched on it a moment ago, but just remind people, what is the Fed funds rate? What does it inform?
Yeah.
Right? And how is that meaningful to the folks listening?
Great question. So what is the Fed fund rate? The Fed fund rate is simply the overnight lending rate that's used by banks. So the Federal Reserve, an independent government agency, right? They're charged with maintaining stability in the bank and employment and whatnot. And they set the Fed funds rate, which is really a suggestion, a recommendation to banks. And it's the shortest of short-term rates. But it's incredibly important because that's the basis, right, that all other borrowing costs and interest rates are really, really driven by. And the guidance and expectation that the Fed issues for future rate hikes, that dictates the cost of money in the US economy. It impacts everyone, everything in one way, shape, or form. And what's fascinating is when we look at this chart, it was barely a year ago where the Fed funds rate was at 1%, right? End of February, at 0%, right? It was literally 0. And a year ago this time, it was 0.5%. And then you look at the right-hand side, the fastest pace of rate hikes in decades. So it's not simply that rates went from 0 to 5, it's how quickly they went. And sometimes we lose sight of that, we forget, but I thought it was a great reminder. And what happens when the Fed raises rates? They're looking to increase borrowing costs throughout the economy. So that's going to tighten credit. It's going to make loans more expensive. It's going to hopefully dampen inflation by reducing the amount of money that we have floating around. Lowering the Fed funds rate has the opposite effect, right? Now you're making it easier, you're making it cheaper to get credit. Lower interest rates, that encourages people to take more risks, right? To borrow more, to invest more. And it gets to the stock market as well. It's not just bonds, right? Because when the Fed cuts rates, the borrowing costs of corporations are lower. Public companies can now spend more, right? More in CapEx, more to grow their business and to boost earnings. So, when rates decline, right, that's why the stock market, and we've had this punch ball out for a while, and we joke, don't fight the Fed. But it's incredibly important to markets, incredibly important to our day-to-day.
So, let's move on to, where we see the Fed funds going, Fed rate funds going, which again informs all these other components. We don't like to make predictions. Again, on our last call, we showed how good the best prognosticators are at making predictions. So I don't want to necessarily predict, but let's use some of the data that we get from some of our partners and talk through what did just the concept of a bank failure, right, or potential bank failures, plus forward-looking expectations of Fed funds rate. Here we've got two charts on the left, just showing expectations, right?
Yeah. And I love this chart on the left from BlackRock because it's simple, it's clear, right? You've got that line in the sand. Prior to the SVB failure, right, the expectation was that rates would continue to rise. And immediately in the aftermath of that, we see how that shifted. Now, obviously, as we've said, expectations don't, often don't match reality. But when you look on the right, you look at what's happened. And now you don't have to look out very far, another year or two, and the expectations are that rates will be back below 3%. So, pretty remarkable, right? The joke is the Fed keeps raising rates until they break something. And, perhaps that's what happened here. It remains to be seen. But if in fact this does end up being that turning point, right, it could perhaps explain some of the gains we've seen in the stock market over the past few weeks.
For sure. And, the next slide, perception and reality. We talk about this always on our investment committee meetings, but what we're seeing, if I had $1 for every time someone said, this is what I saw on the news, these were the headlines. I think the greatest analogy is, right now we see some of these tech companies, 3,000, 10,000, 8,000 employees being let go. The reality is that could be 0.01%, 0.001% of their workforce, and they're shifting, but clearly it's different. So your perspective, what do you see here?
Yeah, that's a great example. And Barry Ritholtz writes about that. He calls it denominator blindness. Because yeah, if a company with 80,000 employees lays off 2,000 of them, that's really, not at all meaningful. But the headline is going to be, Google lays off 2,000 employees, and that's going to send shockwaves and jitters through the stock market. So there's definitely that component to it. We were joking, this is like the everything is awful slide. And our friend over here is literally glued to the TV, right, with his raincoat and umbrella and staring at the thunderstorms. And yet when you look up, it's sunny skies. And to go back to that analogy, even if a company lays off a fraction of a percentage of their workforce, unemployment's at a 50-year low, last I checked,
yep.
Right?
Yep.
And that's not controversial, right? That's the reality. So this notion that, right, everything is awful simply does not square with what we're seeing. Yeah, there are headline risks, right? There's high inflation, the banking crisis, raising rates. All of these other fears are valid, but they don't tell you the whole story.
For sure. And speaking of stories, let's walk through just what's going on specifically in the bond market, and then we're going to talk about the equity markets, both domestic and international. But I kind of came up in the business with the bond guy, and it's really interesting to see since 1982, we only really saw interest rates go down. And obviously we looked at Fed funds, which informs then treasury rates, which then informs municipal bond rates, which then informs some taxable fixed income instruments. And 2022, we saw a bond decline, historical bond decline. But coming out of that, we see and are seeing the highest ever in a really long time rates that investors are getting on their bonds. And what's really interesting to note is that higher yields clearly are better. And temporary impairment in the value of some of the fixed income instruments that clients are using, that other people are using, is temporary if you've got quality in the portfolio. So, I thought this slide was really interesting. 89% of the bond's performance is attributable to the yield. So if we can now build portfolios, if investors can get 4% on their fixed income securities versus what they were getting a year ago, 2 years ago, 2%, it's really attractive. Makes portfolios look really good, and obviously sets up financial plans to be even more successful. So that, to us, that's really interesting. On the right side, it shows the largest drawdowns. Again, 2022, quite historic in temporary bond declines. And then already this year, we've seen some of that recovery. And so if the Fed funds starts to decline, right, we might see ourselves in lower rates in the future. But for the time being, really attractive opportunity in the fixed income markets. We're also seeing lots of opportunities to build really good, high quality portfolios. So if we could, that was the bond market. Let's talk a little bit about the stock market.
Yeah, so that plenty of tailwinds, as you said, in the bond market, and the nature of bonds makes it a little bit easier when you can take the starting yield and extrapolate out. Equities, right, we know don't really work that way. valuations are somewhat predictive when you go out in a decade, but they don't really tell you much at all about the next 5 years. And when we look at the equity market today, and this is, I think we showed this last quarter as well, the Bank of America Fund Manager Survey, it shows that positioning is still overweight cash and underweight equities. And not only that, right, we are underweight equities on the right-hand side at levels we haven't seen again since March of 09. And we all remember, or many of you likely remember, that ended up being the bottom. So typically, or often, right, as a contrarian indicator, when sentiment turns so negative and so bearish, and all the sellers have sold and exited the market, right, that actually is very, very constructive, even though it's a bit paradoxical. CNBC has the All-American Economic Survey. 17 years they've been running it. It has never been lower regarding perception of the economy now and in the future, right? 69% of the public have a negative view. And one thing we know about markets is they have a tendency to fool most of the people most of the time.
For sure. And now we're going to talk about risk assets versus non-risk assets. To your point, when cash on balance sheets, when cash on individual balance sheets is highest, right? Really interesting guide to markets. I can remember in 2009 March, right? Mm-hmm. Consumer sentiment was at all-time lows, right? That was the absolute bottom, right? We saw it 3 weeks after the pandemic, quote unquote, hit in March of 2020, and all of these charts seem to look exactly the same, and those periods of recovery are exceptional. So if you could, Josh, on the left side, we got four weeks rolling flows, and that's risky assets into safe assets. So we'll call it equities or stocks into fixed income. What are you seeing here?
So yeah, I'm seeing an extension of that theme, right? And we've seen it over and over again. And the important takeaway to me is, markets are forward-looking. Markets are discounting mechanisms. They are anticipatory. So what humans do, right? We react, right? We're not anticipatory. We are reactive. So risky assets for safe assets, we've seen tremendous flows out of risky assets into safe assets in response to the perceived risk. Now, the issue is, right, if everyone knows about that risk, isn't it priced in, right? Aren't markets, if you believe in some level of market efficiency, right? And that's the hard part for our minds to really grasp is, yeah, the news can be bad, but that can still make for a very, very attractive entry point if in fact assets are now cheaper. And a lot of that bad news has been priced in, and perhaps overly so because of our, our tendencies to really throw in the towel. So that's what we're seeing here, just really a shift, right? Investors piling into cash, right? Piling into safe assets. And at some point, right, that's going to turn. And when it does, all of that money flowing back the other way, that's going to be very, very much supportive of higher prices.
Right. And we can go back just the last 11 bear markets, right? Dating back to 1950. These are real numbers with the S&P 500. And if you look on the right side, those are really attractive numbers, right? Coming out of these bear market periods where peak to trough declines are 30, 40%. And we've had beyond, 1 year fantastic recoveries and then 3 year annualized. I mean, if we can show our clients these types of returns, that's a pretty awesome experience.
Yeah, that's the old joke, right? The stock market's the only market in the world. Things go on sale and people run out of the store. But clearly this has happened before. It'll happen again, right? Markets decline, markets crash, and every single time historically has proven to be a terrific buying opportunity.
Yeah, and let's look at that for dive in a little bit deeper in what does a recovery look like? What does it feel like? What do those numbers shake out to be? Just getting back to where we were in Jan 3 of 2022.
Yeah, and that's precisely what this is JP Morgan, what they're doing here. They're looking at, right, the return, the January high, the peak was 47.97 of the S&P, and as of quarter end, we were at 41.09. So what they've done here, they've mapped out the implied return, the annualized return based on how long it will take us, right, to reclaim those highs. And keep in mind, we're talking about the January 2022 peak. So we're already removed, what, 15, 16 months from that point.
Yep.
So, you know, if you're of the opinion that it's going to take a year, well, that would mean that the market gains 18.5% in a year. I'll take that.
Take it today.
If you think it'll take 2 more years from where we are, right, again, on top of the 16 months in that we already are, so, you know, 40 months, that's, you know, your 9.8% annualized. And you can do the math and go down. And I think even if you're incredibly bearish and negative and pessimistic, it's hard to fathom, right? It's hard to fathom that this type of recovery is going to take, you know, decades, because on the right-hand side, they show you facts, right? Bull markets, bear markets, and the duration, the monthly duration. And we don't have data on bear markets that lasted decades because they don't exist. So, you know, the probability of us seeing acceptable or you know, perhaps even above average returns from here, I think when you view the data through this lens, it looks quite strong.
For sure. And we're going to switch and talk about some of the leading indicators, some of the items that may in fact inform where the markets go, how the economy is shifting. This here is the year-over-year change in the leading economic indicators. What are you seeing, Josh?
Yeah, I'm seeing more of, you know, our friend who was dressed for Niagara Falls. And, you know, the leading economic indicators, it shows you a slew of different data points that, you know, sometimes have some predictive value when it comes to recessions. And, you know, what I see is something of a mixed bag, which is, you know, not necessarily what the sentiment is showing here, right? Unemployment, we talked about. Unemployment is low. Consumer spending is steady. The consumer is in great shape. Supply chains, if we recall back, they're actually in better shape than they were pre-COVID. So there is good, right? Now there is bad too. There's the yield curve that inverted. There's inflation that is moderating, but still above the Fed target level. So there's good and there's bad. And I think it's important to keep that in mind before jumping to any conclusions about recessions and what those can look like and what they can mean.
For sure. And then we also, we saw a couple of these charts this week came across our desk. Since the recession, you know, I just, some of this was mind blowing, you know, where we are with regards to unemployment rates, where we are with regards to what the consumer's doing. I'm blown away.
Yeah, and that's it right there. I think, you know, you look at employment, you look at the consumer, people making and saving money. Yes, there are risks, and yes, you know, we could be headed for a recession. Nobody knows. But I think this notion that it is inevitable, this notion that all of the data and all of the indicators are pointing one way, I think that's simply not factual.
Yeah.
Right? There's good and there's bad, and I think it's important to maintain that balance.
Totally agree. And we'll go one more slide on that front, just talking about, you know, the CPI, Consumer Price Index, versus consumption versus PPI, sort of the supply and demand of those goods and services.
Yeah, and I mean, this is, you're seeing it, however you want to look at the inflation data and parse that data, right? It's clearly improving, right? CPI, those readings are coming down, and we know that it takes time. We know that the Fed looks back 12 months, and when you look at the monthly data, it's already showing a much more rapid pace in terms of the decline. But, you know, to me, this is encouraging. This is exactly what we would want to see and hope to see.
Great. So Josh, we covered some macro themes, we covered some micro themes, we talked about some recovery in the equity markets, some reversals. We talked about, you know, where the consumer is, where Fed funds are. You know, we put together, you know, a couple more slides and charts to show everyone. These sort of hit home, smart decision making, stay focused on what you can. So if we could switch gears a little bit and talk about some of our favorite charts. So this is someone in our firm, their favorite chart here.
Yeah, I love this one. This is Ashby Daniels, and this is one of the questions we get most often. And Michael jokes that risk is probably the most misunderstood or misused word in finance, and I think there's a lot of truth to that. But I love how they really break this down here. So, risk is not on the left, temporary volatility, right? And, how do we measure risk? The academic sense, the market sense, you look at standard deviation. Standard deviation is not what our clients are worried about, right? Our clients are worried about, on the right-hand side, really two things. One is permanent loss of capital, right? This notion that your assets, your investments could literally go to zero, which is obviously, a terrifying thought. And clearly, right, that would be an acceptable definition of risk. The problem is, if you're properly diversified, that risk is effectively nil. And I don't say that lightly, right? But the stock market, right, individual stocks and individual companies, sure, they come and go. The market globally, a diversified portfolio, not only has it never gone to zero, it's up 97x, right, over the last 65 years. Now, there are highs, there are lows, there are ups, there are downs, and all of that we know is normal, right? We have to endure that periodic volatility, but the notion that, right, the permanent loss of capital, as long as you have a prudent plan and you're diversified, right, that's a risk that we can actually, really easily solve for. Now, the one on the right, that's the harder one. The one on the right is any decision, right, that reduces the probability of achieving your goals. And, it's almost paradoxical, but not taking enough risk or, perceived risk in the form of volatility, right? Not being invested prudently, not allowing your assets to grow at a rate that's going to keep pace with your spending needs and with inflation and with your futures. That risk, right? The potential that you outlive your assets. That's the real risk that I think prudent planning and prudent portfolio management and investing and saving, that's the risk that we can actually really, really solve for. And it's real, but it's not volatility, right? It's leveraging that volatility in an effort to achieve goals.
Absolutely. And another favorite chart, sort of in that same vein, that same theme, is the Callan chart, which we've all been looking at our entire careers. One of my favorite charts.
Yep.
Each box represents a different asset class. Really, really difficult to find a pattern or a repeatable pattern. The one thing that we've identified is here in the middle, you've got an asset allocation portfolio, right? Yeah. And that asset allocation might be, adding a little bit of fixed income to an equity portfolio, adding a little international to an all bond portfolio, whatever it might be. Just having that asset allocation component really, in fact, reduces some of the volatility inherent in a portfolio, but doesn't necessarily take away so much of the return. Seeing anything different? Anything else pop out here?
Yeah, I mean, it's funny, from where I'm sitting, I can't even make out all of the classes, but what I do see, and it's clear as day, right? From one year to the next, just looking at the colors, looking at the images, right? The best performing asset class on top, right? From one year to the next can flip and often does flip, and it's the worst performing asset class. And many of us assume, right, that the value is in being able to figure out in advance what's going to be the best performer. But what I focus on, you mentioned that gray bar in the middle, the asset allocation, because when you look out towards the right and you look out over time, right, it's actually one of the best performing, right? So not picking winners and losers, right, over time actually gives you one of the highest returns. And that's the lesson of diversification, right? And that I think is the whole idea. So yeah, it's great to see, not just from one year to the next, but over time how that asset allocation performs and ends up outperforming the vast majority of assets.
And worth noting, the far right two columns, the one on the left shows the returns and the one on the right shows volatility, right? So you're actually getting a better than average relative performance with significantly lower than average volatility. So absolutely, such a great chart.
Yeah.
The other thing that we look at a lot, again, we're picking on a 60-40 to represent some diversification, but any portfolio should have declines. You're taking a risk, right? And so here we're showing a 60-40 portfolio over time. And I think what's paramount here, and you said it the other day, is that every portfolio, right, is going to have really great periods and not so great periods.
Yeah.
So I think that's really interesting. Even a relatively conservative portfolio will have those declines.
Yeah, and that's spot on. And you know, if you take the trend line and you look at the average return for this type of a portfolio, a moderate, a balanced portfolio, right, it's going to be about 7%, 6-7% annualized for the past 70 some odd years. But yeah, once every 4 or 5 years, you're going to have a down year, and that's to be expected, and that's okay. I know it's not pleasant in the moment, but attempting to time that and attempting to avoid it, we know is going to cause way more pain than simply embracing it and allowing the market to do what it does and achieve those returns that in turn allow investors to meet their goals.
Great. So we've got one more slide, sort of take it home. This is a slide, obviously, it is so meaningful for the components of what we're doing here. But I think it actually has so many more applications in everyone's life. Not to give advice beyond our scope, but here we've got on the left side things that matter, right? On the right side, you got things can control, and the combination, right, where those cross is what we should focus on.
Yeah, I mean, I'm thinking that this would be a great thing to hang up in my kids' room, rooms. But yeah, it's true in markets, it's true in life, of course. But in markets, it's easy to get bogged down by all the noise because it's everywhere we look, and because pessimism and negativity, right? That's what sells, that's what leads, that's what sounds smart. What we know, right? Evidence-based investing, we know that security selection, market timing, really does not matter all that much over the long term. It really does not. And we also know, some of us may admit it, some won't, but we know we can't control that. We know we can't predict the future. Now, the things that do matter, the things that we can control, your savings rate, your asset allocation, right? Your plan, 1,000% matters, 1,000% within your control. Those are the things that we focus on.
For sure.
And the rest of it, right? It's noise. So can't stress that enough.
Great. Well, thank you so much, Josh, for taking the time and walking us through this great Q1 outlook and review. We're going to have these slides available to everyone that was on the call. Also happy to discuss any of these items in further detail. Feel free to let us know if there's any questions, comments, and we'll see you again for the Q2 update.
Yeah.
Coming in a couple weeks.
Looking forward.
And with that said, have a great week, and we're almost in the summer, and enjoy the summer. Be safe, be healthy, take care.
Stan, take care.